Stocks, shares. When you buy a stock, you're purchasing a unit of ownership in a company. Think of it this way. Every company is like a pie, and each share represents one slice of that pie. If you own Apple stock, you literally own a tiny piece of apple. The company is partially yours. Now, there are two main types: common stock and preferred stock. Common stock usually comes with voting rights at shareholder meetings and dividends that can vary. Preferred stock typically offers fixed dividends, but no voting power. Either way, owning stock means you have a claim on the company's profits and assets. Here's what matters. When the company does well, your shares generally increase in value. When it stumbles, your shares can drop. That's the trade-off. Stocks offer serious potential for returns through price appreciation and dividend payments, and you can usually buy or sell them quickly on exchanges. But the risk is real. A bad earnings report or negative news can tank a stock's value overnight. The Amsterdam Stock Exchange started all this back in 1602, trading shares of the Dutch East India Company. That was the first modern public market. So when your slice of the company cake grows, you profit. When it shrinks, you lose money. Stock exchanges and markets. A stock exchange is an organized marketplace where stocks get bought and sold. These days, most exchanges are electronic networks, though there used to be physical trading floors with people shouting orders. The exchange sets listing standards for companies and provides transparent pricing so everyone can see what stocks are worth at any moment. When a private company decides to go public, its stock gets listed on an exchange like the New York Stock Exchange, Tokyo Stock Exchange, or London Stock Exchange. From that point forward, anyone can trade those shares. Picture it like a farmer's market, but for company ownership. Companies bring their stock to the market, and investors browse and trade. Here's a concrete example. When Google launched its IPO in 2004, its shares started trading on the Nasdaq exchange. To get listed, companies have to meet requirements around financial reporting and governance standards. The big advantage of exchanges is liquidity. With tons of buyers and sellers present, you can usually trade shares quickly at fair prices. Exchanges also enforce regulations that protect investors from fraud. The downside includes trading fees and the potential for market crashes when panic selling hits. Stock market index. A stock market index tracks the performance of a group of stocks. Think of it as a snapshot of how a particular segment of the market is doing. The S&P 500, for instance, represents 500 large US companies by market value. The FTSE 100 covers 100 major UK companies. Each index calculates its value differently, but most weight by market capitalization. Indexes serve as gauges for overall market health. When the index rises, the market on average is going up. When it falls, the market is declining. The Dow Jones Industrial Average dates back to 1896, making it one of the oldest. Japan has the Nikkei 225. India has the Nifty 50. Investors use indexes as performance yardsticks. You can compare your portfolio returns against an index to see if you're beating the market. Better yet, you can invest directly in index funds or ETFs that replicate an entire index, giving you instant diversification. The advantage here is simplicity. Instead of analyzing hundreds of individual stocks, you follow one number. The downside is that no index captures everything. Smaller companies or foreign firms might be excluded, and sometimes a few massive stocks drive most of the gains while many others fall. Market capitalization. Market cap. Market capitalization tells you the total market value of a company's outstanding shares. The calculation is straightforward. Multiply the share price by the number of shares issued. If a company has 1 million shares trading at $50 each, the market cap is $50 million. This metric determines how companies get classified. You'll hear terms like mega cap, large cap, mid cap, small cap, and micro cap, all based on market cap size. Here's something interesting. Two companies can have identical share prices, but wildly different market caps. Say, Company A and Company B both trade at $10 per share. But if Company A has 10 million shares outstanding and Company B has only 1 million, Company A's market cap of 100 million is 10 times larger than Company B's 10 million. Market cap gives you a quick read on company size and risk profile. Larger companies tend to be more stable with established business models. Smaller companies often grow faster but carry more risk. Indexes like the S&P 500 weight by market cap, meaning bigger companies influence the index more. The catch is that market cap can mislead you when share prices swing wildly or when companies have unusual share structures. It also doesn't factor in debt. Dividends. A dividend is a portion of a company's profits paid out to shareholders. When a company makes money, the board of directors can decide to distribute some of that cash to stockholders. Most dividends come as cash payments on a per-share basis, like 50 cents per share every quarter. Sometimes companies issue stock dividends instead, giving you additional shares rather than cash. Regular dividend payments signal that a company is profitable and confident about its future. When a company cuts or eliminates its dividend, that's usually a red flag indicating financial trouble. Established firms like Coca-Cola and Johnson & Johnson pay dividends consistently every quarter. These payments provide steady income to investors, which becomes especially attractive when the overall market isn't growing much. Dividends contribute significantly to long-term investment returns, sometimes even more than stock price gains. If you reinvest those dividends by buying more shares, you get compound growth over time. But not every company pays dividends. Younger companies or fast-growing tech firms often reinvest all their profits back into expansion instead. And dividends are never guaranteed. During economic downturns, companies can reduce or stop dividend payments entirely. The Dutch East India Company paid dividends back in the 1600s, making it one of the earliest examples of this practice. Bull versus bear markets. These terms describe the general direction of the market. A bull market means stock prices are rising over an extended period, reflecting optimism and investor confidence. A bear market means prices are falling, reflecting pessimism. The conventional definition of a bear market is a drop of at least 20% from recent highs. The US market from 2009 to 2020 was a long bull market, with stocks climbing year after year. The 2008 financial crisis and the early 2020 COVID crash were bear markets, where values plunged. In bull markets, portfolios grow, economic indicators look strong, and investors take more risks. People feel wealthier, companies can raise capital more easily, and new ventures get funded. Bear markets work in reverse. Stock declines feed on themselves as confidence evaporates. Selling triggers more selling in a downward spiral. Your portfolio value can erode quickly, hitting retirement savings and company valuations hard. But bear markets create opportunities too. Prices fall to more attractive levels, letting investors buy quality stocks at discounts. The phrase is buy the dip. Bull markets can become problematic when they turn into bubbles, with prices rising too far and too fast based on hype rather than fundamentals. Historically, markets tend to rise more often than they fall over the long term. But the cycles between bulls and bears are inevitable. Volatility. Volatility measures how wildly and unpredictably stock prices move. Technically, it's the statistical standard deviation of returns, but in practical terms, high volatility means prices swing up and down sharply in short periods. Low volatility means prices change slowly or barely at all. A penny stock that jumps or crashes 10% in a single day is highly volatile. A stable utility stock that only moves 1% is low volatility. Markets measure overall volatility through indicators like the VIX, also called the Fear Index. Volatility signals uncertainty. News events, earnings reports, or broader economic factors can trigger sudden swings. For traders, volatility creates opportunity. Large price movements mean more chances to buy low and sell high in the short term. But volatility also means risk. A highly volatile market can swing against you fast, causing substantial losses. For long-term investors, extreme volatility can be nerve-wracking even if you're not planning to sell. The good news is that volatility tends to mean revert. Periods of wild swings usually get followed by calmer stretches. The COVID-19 outbreak in March 2020 caused one of the fastest volatility spikes ever recorded, as markets reacted to massive uncertainty about the pandemic's economic impact. Liquidity. Liquidity refers to how easily you can buy or sell an asset without significantly affecting its price. In the stock market, a highly liquid stock means you can quickly sell shares at close to the market price because plenty of buyers are ready. An illiquid stock means fewer buyers, so selling large positions might force you to accept a lower price. Shares of major companies like Microsoft or Toyota trade millions of times daily, making them extremely liquid. A tiny biotech company that only trades a few hundred shares per week is illiquid. Liquid markets have narrow bid-ask spreads, which is the small difference between the buying price and selling price. They also have high trading volume. Illiquid markets have wider spreads, and prices can jump dramatically if a large order comes through. High liquidity benefits everyone. You can enter or exit positions quickly at transparent prices, and you're not stuck holding shares you want to sell. Low liquidity makes investing riskier. You might struggle to find buyers when you need to sell, or you might have to discount your shares heavily to attract interest. In practice, stocks from a few large companies dominate trading activity, while smaller exchanges and over-the-counter markets contain many illiquid stocks that barely trade. Initial public offering, IPO. An IPO is when a privately owned company first offers its shares to the public. Before an IPO, the company's ownership stays private, held by founders, employees, and private investors. The IPO changes that by selling shares to anyone who wants to buy them. The main purpose is raising capital. Companies use IPO proceeds to fund growth, pay down debts, or expand operations. After an IPO, the company's shares trade on a stock exchange like any other public stock. Companies typically hire investment banks as underwriters to set the initial share price and market the shares to institutional and retail investors. Google's 2004 IPO raised $1.67 billion. More recently, companies like Zoom and Snap had high-profile IPOs that generated significant attention. IPOs give companies access to large pools of capital and boost their visibility and credibility in the market. For investors, IPOs offer a chance to get in early on a company's growth story, but IPOs carry substantial uncertainty. Since the shares start trading without much prior market history, prices can be extremely volatile in the early days. New public companies often lack extensive track records, making their valuations speculative. The late 1990s dot-com bubble saw countless IPOs that soared on opening day, then crashed and burned when the bubble popped. Many of those companies went out of business within a few years. Diversification, risk management. Diversification is an investment strategy that spreads your money across different assets to reduce risk. The classic saying is, don't put all your eggs in one basket. A well-diversified portfolio might include stocks from various industries, bonds, cash, and possibly real estate or other assets. The logic is simple. If one investment falls, others might hold steady or even rise, offsetting your losses. An investor might allocate money to technology stocks, consumer goods, energy, healthcare, and government bonds. If the tech sector crashes, gains in other areas can cushion the overall portfolio impact. Diversification lowers volatility and reduces the chance of catastrophic losses. It increases the likelihood that at least part of your portfolio performs well under different market conditions. The trade-off is that diversification can dilute your gains. If one stock in your portfolio hits a home run, you only capture a fraction of that success because your money is spread across many holdings. Managing a heavily diversified portfolio can also get complex, requiring you to track multiple assets across different sectors and asset classes. Harry Markowitz formalized diversification principles in his modern portfolio theory during the 1950s, showing mathematically how balancing risk and return across assets creates more efficient portfolios.